So in this video, I want to talk a little bit about how I manage risk when it comes to trading options. When I'm trading options in the US stock market, I find that when following the underlying stock, you can set a predetermined stop loss amount, but if you're trading options, if your stop loss gets hit, you can end up losing a little bit more than what you were anticipating or planning for that specific trade. I've basically traded based on a predetermined dollar amount that I'm willing to risk per trade. I know what the sizing will be based on that. And I know that if the stock does go in my favor, I'll be able to take profits. But in the case where it does not go in my favor, when am I going to exit on the chart? In the past, what I've done is I used to manually exit based on the chart. I used to draw a line. I used to know the specific price point that I would exit. But I found over the last few years that I was risking way too much per trade, or the predetermined loss amount that I would estimate, it would always end up surpassing that. What actually ends up happening in the long run is those losses, especially in months where you may not get the most out of all your trades, you may not be able to get more winning trades, that can impact how much profit you're able to make, or it actually could be the reason why you end up in a loss. So when trading options, I always ensure that I'm exiting based on a predetermined premium amount. And the other way that I also manage this is rather than manually exiting, I have determined that predetermined amount and I let the system exit for me. So I want to go over a little bit of a chart example when premiums take a hit and your decision on when to exit might end up making you lose a little bit more. So in this example, I have the chart of QQQ. On days when stocks are choppy or the price action is not favorable, there's a lot of moving up and down. There's, large candles that take over all the buyers and then buyers come back and then there's just consolidating. You may set an amount predetermined on terms of your dollar risk per trade. You may have an idea on the chart where you're looking to exit because it's a clear invalidation level for you. Whatever your thesis and decision is on that, sometimes what happens is if the stock is consolidating, your premiums start to lose value. And when it finally reaches your invalidation level, you end up losing more on that trade. And that is a very frustrating experience to have. And I've been there many times before. So what I know now based on the way that I trade, and I trade the 2-minute chart on QQQ, I know that over a series of trades, I have a predetermined premium stop loss that I'm willing to set in the system, and the system will automatically take me out. I've also used manual ways of doing this where, I would watch the premium chart, see, hey, look, if these premiums are not moving in my favor, if I'm still below break even, if it goes past a certain amount, I'll exit. But that manual intervention was quite challenging and hard for me to exit, especially when the trade is still consolidating. But if I look at my original plan, it was that if the price or the risk on the trade based on a dollar or percentage amount goes beyond a certain point, that's the most comfort that I have in staying in this trade. And 9 times out of 10, I have found also that when I decide to exit based on the premium, this is something that I've determined to be a comfortable premium amount, and I'm going to go over a little bit about the different levels that I would recommend that have worked for me on a 2-minute chart or a 1-minute chart or even 5-minute chart. That amount will ensure that my trade does not go red beyond a certain amount, and it usually is the best area for me to exit because the trade is likely to further invalidate. The trade is not moving favorably. The premiums are also dictating the buyers and sellers and their hypothesis and commitment to the trade. So all of these factors considered, when I set it based on the premium amount, and this is an amount that gives enough wiggle room, but just enough that if it decides to go under, the trade exits for me, I'm comfortable with accepting that that's the outcome of the trade. 5% of the time, maybe the trade will go in my direction, but I'm willing to sacrifice those trades in order to protect the losers that I have in the short term. And it also depends entirely on how much your risk reward is, or R multiple, or the profit factor that you're expecting on a trade. But if a trade is moving and you're moving towards the upside and it gets rejected, it goes up and gets rejected again, it's breaking out, and you're just not liking the price action, for me, it's going to be a lot harder to exit that trade when there's a chance or possibility that it could still go in my favor. I'd rather let the system take me out because the trade is clearly showing some red flags. And so the amounts that I have determined are the following. For most of my trading career, it's been around 50 cents. This was a manual exit sort of method where if the premiums went to a certain amount, I would exit, or basically the invalidation point on a chart would match to approximately 50 cents. If you're trading at the money contracts, there's about a 50-cent delta. So if a stock moves against you $1, you're losing about 50 cents per contract. But for me, that was a little bit too much. And I've tested out over many series of trades. I've reviewed all of my footage, and I have found that 50 cents was a little too much room, because by the time it gets to that amount, that's when a lot of sellers are exiting the trade. They're deciding to hit stop losses, or they're basically marketing out, and the spread would open up. So I would end up losing a lot more on the trade. So then I brought it down to about 30 cents. And after reviewing all of my trades, I realized, there's still slippage. I'm still staying in losing trades when they have identified earlier on that this trade is a red flag. It's not really going to work. It's more likely to fail. So over, more periods of back testing and reviewing all of my trading footage and recording it, which I highly recommend you consider, because it will allow you to get a sort of bird's eye view of what you're doing in the moment without having to think and remind yourself what I felt in the moment. So then I brought it down to about 25 cents. So 25 cents is a level that I'm comfortable with. Most of the trades, when they hit 25 cents against me, assuming that I have the right entry, assuming that I'm entering the trade at an appropriate time, it's usually a sign that the trade is a red flag, and I'm happy with the trade getting me out, with the system taking me out. And that automatic process is actually really easy, because manually exiting when the premiums are bleeding and the trade is still holding is actually very difficult to do. And if you want to succeed in trading, I think what's helped me find a lot more progress and success in my trades is when I let the system make decisions for me where I don't have to hesitate on. Now, this might not work for everybody, but it's worked really, really well for me, because it's not my winners that are keeping me from getting the progress on a weekly basis that I'm always trying as I'm increasing size. It's usually the losers that end up taking 2 losses away, or maybe 1.5 loss away. It's the slippage, it's the nature of option contracts that I find are really difficult to manage in the intraday. I've seen traders where they're really good at exiting as soon as they see one candle go against them. For me, I want to give a little bit more room than that. So I have found that the 25-cent stop loss amount is actually really great for a 2-minute chart, for scalping, for trading breakouts, breakdowns, buy setups, sell setups. If you're looking at opening range breaks, even reversals, I can use this, especially if I get a good price on the fill. But what I'm trying to say here is that, having a predetermined price point is really important when it comes to options. You can try to exit manually when the premiums are decaying or moving against you, even though the chart is not yet invalidated. But if the premiums are moving against you, that's usually a red flag. So manually exiting is one way, and automatically exiting is another way. And different platforms handle this a little bit different. When it's automatically going to exit me, it's automatically going to submit a market order, and I'm perfectly okay with that, because I'm usually exiting a little bit earlier than everyone else, so I won't experience as much slippage or the spreads affect me that much. So this is one clear way that I've been able to manage risk on the downside when it comes to options. Again, knowing your predetermined premium price, knowing how to implement it, whether you're doing it manually or automatically, is really helpful. I find that automatic is really, really helpful, but you're going to have to go through and review your trades, review your footage. And if you're not journaling your trades, if you're not watching your footage, if you don't even have that type of information available to you, it's going to be a lot harder to make those little improvements. I hope you gain value from this video.